I may have released a pre-sale for a brand new course. You might want to check that out down below as well. It's different from all of the other courses. Hey everyone, me Kevin here. In this video, we're going to talk about my new $3.5 million short. We're also going to talk about what I believe is happening in the market right now, why the market is acting the way it is, and why it feels like pain is coming back to this market. Keep in mind, if you want all notifications for when I buy or sell stocks, whether I make a new move or I exit a move, check out the Stocks and Psychology of Money program, linked down below. It's a program on building your wealth through investing in stocks, and you'll love the foundations of building up your knowledge with the psychology of money and learning how this market functions without having to think the market's rigged, because now you can play the game. Check it out. You get lifetime access to the lectures, and you get access to all my buy-sell alerts and course member live streams when you check it out. Check it out along with all the other programs linked down below, and check out before Black Friday, when that Black Friday sale ends. Okay, let's get into what's happening in the market, and then we'll talk about this new big short here. Okay, so first, it's worth noting that a lot of institutional investors, in my opinion and in the opinion of Bloomberg researchers, got into the tech rally a little bit late. They and when they got in late with a lot of money, they ended up pumping up the values for stocks like Tesla because they had missed out. In my opinion, Lucid, Rivian, because they had missed out on Tesla runs. They pumped up the values for companies like Enphase or Etsy or Affirm. These are really high quality companies that are trading at pretty expensive valuations. There's a reason I've stopped buying these companies many months ago. Well, maybe not many months ago, but about 2 months ago we had a dip in September, right? End of September, early October. That was a perfect time to buy. People are always like, oh, but Kevin, you can't time the market. It's like, really? Like, look at September. It's worth looking at it again. Here, take a peek at it, and then I want you to compare what the dip is that we have now compared to September. I think it'll really help give you some perspective. So take a look at this. This was your September dip right here. The end of September dip, bottomed on about 920, double bottomed on about October 4th, and then we took off. Like, what we're experiencing now is nothing. I mean, look at that. We've barely experienced anything yet. However, this is either going to be an inflection point, or we're going to break through and see something where we end up trading under the 20-day moving average again for a few weeks as individuals are concerned about, well, what they're concerned about in this market. Now, I'm going to talk about exactly what the concerns are in this market, because not everyone believes that the market could be at an inflection point and that it might rotate to the downside, and that's okay. Like, honestly, I'd rather it not. Take a look at where the selling pressure is located. It's mostly not in the Dow. The Dow is relatively flat, up 0.11%, but it's in the S&P, and it's especially in the NASDAQ. NASDAQ Technologies down 1.5% today, but the S&P also down about 0.5%. Okay, cool. So why is this happening? Well, I believe it's because we had a lot of institutional investors get into technology stocks relatively late. Okay, fine. So they pushed up valuations to do crazy highs. Now what? Like, why all of a sudden would prices be falling for these companies? What's the problem? Why are we seeing a sell-off, especially after Jerome Powell got renominated? Like, we were uncertain that if the Federal Reserve ends up getting a new nomination of somebody totally different, then that would increase market uncertainty, which could lead to a potential market sell-off because, well, we don't know how another Fed person would act, right? Well, something very interesting is happening, and it's kind of the same thing in reverse. The market is actually a little bit concerned that Jerome Powell is going to take longer to respond to inflation. And because he's potentially going to take longer to respond to inflation, we're going to end up with more inflation for longer. And while this transitory inflation lasts longer, we're starting to see the bond market and the stock market price in the fact that we might have to discount future earnings of higher valuation companies more. Now, I'm going to talk about my big short in just a moment, but I want to talk about the 10-year Treasury. Look at the 10-year Treasury from when Jerome Powell was renominated and compare it to where we stand now. So what we're going to do is we're going to go to the 5-day, because we know Jay Powell was renominated on Monday. Monday was the 22nd. Take a look at this. 10-year Treasury yields on Friday had fallen to a new low, or recent low, of about 1.53. As soon as Jay Powell was renominated, Treasury yields jumped up to about 1.59, and they've been on a steady climb since then, heading to about 1.662. if market history gives us any guide as to how much the market might price in treasury yields rising and how much longer pain could last in this market, it's worth taking a look at what we previously had in September, October, and in March through May. Take a look at this. In September, when we first started having pain in the market, we went from treasury yields of about 1.27 all the way up to about 1.53. So we got that big dip in the S&P 500, dip 1 with a 0.2% change on the 10-year treasury. The pain continued with another 0.1% change in the treasury. So we could get a whole 0.3% change. A 0.3% change from where we started at the beginning of the week could put us somewhere in the range of 1.72 to 1.82, which, take a look at this. If we go to the big sell-off that we had earlier in the year that led to the pain in March, April, and May, we had an explosion of yields from about 1.15 all the way up to about 1.73. Now that's a lot larger of a move. That's about a 0.6% move, much more substantial, but we were coming off some pretty dang low lows. So instead, I would probably look at this as a little bit more of a chartist, and I would say, hey, we might see yields easily pop back up to 1.72, not necessarily to a new high of around 1.8. I certainly think sitting around this 1.7, 1.6 number is very realistic, and that's kind of the peak that we saw in October as well. And we're almost there, right? We're at 1.66. So what I mean by this is I think the market still has some room to price in pain. If the 10 years run all the way up to 1.8, 1.82, I expect tech will continue to sell off, and we could see a nice little buy the dip opportunity before the end of the year. We'll see what ends up happening because, as we know, markets are difficult to predict. But what do you know about my portfolio? Well, you know that I'm pretty dang long. About 15% of my money is not invested in the market, well, with the exception of now my big short. So we'll talk about that in just a moment. But most of my money is in. So about 85% of my money is in this market long. So that means when Tesla's down 7%, it's a painful day. When Etsy, Enphase, Affirm, when these companies fall, it's a painful day. Like the value of the portfolio falls a lot and fast. So I wanted to find a way to short this market without having to have the massive risk of buying short-term puts and then seeing them quickly U-turn on me. Now, don't get me wrong. I love the idea of buying short-term puts against something like a Rivian or a Lucid. I think, and not financial advice, nothing in this video shall be construed as financial advice, but I love the idea of shorting Rivian. Darn it, I should have shorted it like 10 minutes ago because it was green and it's just started falling. But anyway, I love the idea of shorting Rivian. I love the idea of shorting Lucid. I love it because I think these companies are substantially overvalued. Now, shorts are a little expensive, like purchase puts are a little expensive on Rivian, a little expensive on Lucid right now. But if the EV sector ends up coming to a halt, having a short position against Lucid and Rivian, a put position against these, would be a very good idea. And actually what I might do, now that the more that I think about it, I might actually increase my short, and I'm probably going to do this. I'm probably going to buy some options against Lucid and Rivian as well, but they're going to be a lot smaller than my big short. That's because when you buy like 30-day puts or 25-day puts, the value of these puts can move very, very quickly. You can make a lot of money really fast, but you could also lose a lot of money very, very quickly. Now, to some degree, if the market in EVs rallies, my Tesla will take me to the moon. It's fine. Like, I'll just have a little bit less moon money. If the market in EVs plummets, I'm going to get killed on Tesla. I think Lucid and Rivian will fall twice as hard as Tesla. It's not necessarily the case today, but in the long run, I believe that. And having a short position against them would probably be a good idea. I honestly don't know if I would go for December or January. At this point, I might pay the extra and go for a January put. But we'll see, just in case you have an end of the year kind of profit-taking cycle. But what is my real big short? Okay, you ready for this? Let me give you a little bit of information first, because it's going to help you kind of understand why I'm making this bet. And I'm, of course, going to mention again, you should really check out the programs I'm building your wealth link down below and use that Black Friday coupon code. And then we can have a conversation about this in our live streams. But anyway, here's a stat that you need to know. At the start of the fourth quarter, hedge funds had 33% exposure to high growth and high valuation companies, which are companies that exceed 10 times sales. The start of the fourth quarter was October, And that was really dip time. And that number, in my opinion, has substantially increased. I wouldn't be surprised if a lot of hedge funds have closer to 50% exposure to high growth and high valuation companies. Remember, a lot of hedge funds like to hedge. And if hedge funds start hedging more, then we'll get less buying pressure on technology. When we have less hedge fund buying pressure on technology, technology is more likely to fall because as people sell and there are less buyers, prices come down. But in addition to having less buying pressure on technology because it's no longer the sexy thing right now because everybody's making fun of it, I think hedge funds are likely to hedge, which means shorting and potentially making similar plays to what I'm making. I just want to be earlier than them at doing this. Now, I've already shorted the market once very, very profitably, and I'm doing it again today. And so I'm going to show you a lower risk short that I'm making. And the reason as well that I think institutions are the ones sort of at the center of a lot of the sell-off that we have right here is, take a look at this. I'm going to pull this up. This was the video clip from yesterday's live stream. And take a look at this. NVIDIA falls about an hour before the close and really sells off going into the close, right? Let's fast forward yesterday's live stream. Look at that. It just kind of keeps falling into the close. And look at that volume. That's not retail volume roller coasting these stocks down. This is end phase. That volume at the close, that's institutional volume, in my opinion. I can't know for sure, but that's usually when institutions close and when they hedge. It's towards the end of the day. So you get these roller coaster sell-offs. But it wasn't just in NVIDIA or end phase. It was in NEO. It was in JP Morgan, which implies index selling or index hedging. Apple, also index shorting, index hedging. Look at those falls into the close here, folks. Google, PayPal, Net. These guys were selling off into the close. Very typical institutional sell-off period. So I think it's possible that fear is going to return to these institutions and we're going to have a little bit more pain longer for a lot of these different companies. So what do I want to do to short the market where I'm not going to get rich really quick, but I hopefully also won't get killed really quickly, right? And that's important because with a short position, again, you get puts, you get destroyed, you could get destroyed very, very, very quickly. So it's high risk. Well, there's a new product that came out. I'm not sponsored by them, but I am invested in their product. And it's called SARK, and that stands for Short ArkK. Short ArkK is up 14% since they launched a couple weeks ago. They use swaps to basically short the underlying securities in ARK Invest. And so the way this works is if ARK Invest goes up, this goes down. If ARK Invest goes down, this goes up. Now, unfortunately, at the time of this recording, ARK kind of has been going straight down all day, but we're having a little bit of a push up here right now, which this would just be so much more beautiful if I were recording this while it was going down, but that's okay. Doesn't matter so much. This is ArkK. And so as ArkK is going up, we're going to expect SARK to go down. So let's go on over to SARK. Here it is. It's up 4.5% today. And there you go. It's showing a little bit of a rotation to the downside. Now, I have I have 100,000 shares of SARK. My plan is to stay in this position very, very briefly. Like, I don't want to be in this for the long term. I don't want to short Kathy, short the market for the long term. This to me is probably a play that I'm interested in making for the next couple weeks. And that's specifically because I'm looking for a dip in the market. If this market sell-off reverses and stocks start rallying again, kind of like how the market responded in a weird way this morning and we got a little bit of a rally again this morning, then this isn't going to do too well and I'll probably close my position. I expect my downside risk is maybe 10% because it's not like a leveraged, it's not like an option. If I see, trends changing, treasury yields falling, tech going back up, I could easily step out of this position, small hedge. But the more my technology stocks sell off, the more I'm bleeding, and I have, in my opinion, a relatively cheap insurance policy against at least a portion of my portfolio, against about 12% of the portfolio. If ARK and tech continue to sell off, this should be a tool for giving me more money in a dip. And I think that's cool, is that if I can have money not just in cash on the side, but some of it in an SARK where it's relatively low risk, I'm not going to lose a lot of money, in my opinion. No guarantees. Like I'm not a financial advisor. I can't tell you this is low risk. but what I believe is potentially lower risk, certainly compared to options, right? If this ends up, if the market ends up crashing, and Tesla sells off 20-30%, ArkK Invest sells off 20% or whatever, cool, I'm going to have 20% more money to go buy the dip. If the market rallies, great, I'm going to be making a killing on my tech stocks, and here on my SARK position, I'm going to lose a little bit, 10-15%, whatever, but I'll probably close that position as soon as I see kind of a U-turn in the market. I watch the market pretty regularly, and of course, once I cycle out of this, I'll definitely be, as always, sending an alert to everybody in the Stocks and Psychology of Money group. And so really keep it, the cool thing is what you really just have to do is watch what ArkK does, because SARK is going to do the opposite. We're seeing a little bit of potential buy the dipping right now, but then again, we saw that throughout the day, and then we ended up pulling back to lows. So obviously on the minute candlesticks, you're going to have some pain. You look at the hour candlestick or the day candlestick on ArkK. Look at this. We've really kind of just started selling off here. It makes you wonder if we're going to get back down to May lows. I wouldn't be surprised if we do. So maybe another 10% drawdown. No guarantees though. Generally, I'm long in this market. I don't like to short the market. So there you have it. Thank you so much for watching this video. Check out the programs on building your wealth down below, and check out the pre-sale for the new course as well. All right, folks. Bye.